Welcome, everyone, to the Investing with IBD podcast sponsored by North Coast. It's Justin Nielsen here, and we also have Arusha Pires from O'Neill Global Advisors, a portfolio manager there, as always. It's April 20th, 2022, and our special guest this week is Eric Krull. He's also the manager and founder of Krull Asset Management. He was a meetup leader from Naperville long ago. That's where I met him. 15, 20 years ago it
Yeah.
must have been. Is that right, Eric?
Yeah, it's been that long. Yeah.
Yeah, something like that. So it's a great to have you on the show. How are you doing?
I'm doing great. It's great to be on your show. I've been listening to you guys for years, and it's a pleasure to be here.
Yeah. So on the show today, now we had Eric on IBD Live not too long ago, and we were really getting into the follow-through day concept in a pretty deep way. And one of the things that people were requesting is, man, they wanted more. So Eric was kind enough to join us on the show to share some of the research that he's done over many years, and of course, it's one of those things that just doesn't stop. We're
Right.
constantly adding to it. So we're going to get into a deep dive of that. So we're going to start with that investing lesson this week, and then we'll get into a little bit of the current market in the second segment at the end of the second segment, because we want to give this one a lot of time. And as always, we're going to cover a few stocks that might be on Eric's radar. So let's hop right into it. So Eric, tell me a little bit of why you decided to do this whole study and get so nerdy on this.
Well, it all started about 20 years ago when I first started investing the Can Slim method. And I read in one of the books, I can't remember which edition, it was one of the early ones, where Bill said something like 70 to 80% of successful rallies start with a follow-through day. And when I heard that, I thought, well, those odds are really in your favor. If you're going to be right 70 to 80% of the time, of course you'd bet on that. And I found back in like 2002, 2003, when we had a great bull market, that I was confusing brains with a bull market. And there were times when after that, I would be plunging in with a lot of my capital right after on a follow through day or soon after, and it wasn't working well. And I'd be giving back gains from prior years, or just taking losses. And so it became obvious to me that 70 to 80% of the follow through days working or being successful wasn't really right. And so I decided to dig into it deeper, and I started to study follow through days analytically, and start looking at how much you gain, how long they last, and the time it takes to get from one follow through day to the next, and so on. And that's how it all started.
Mhm.
Eric, so when you said that you're plunging in, were you just buying kind of like the ETFs at that point, right when you saw fall today, or were you plunging into the first few stocks that were breaking out?
I was plunging into stocks, individual stocks that I thought were leaders.
Okay.
I think when I started this, there weren't even that many ETFs. I think there was the
Yeah,
QQQ,
that's
and that
true.
was it.
Yes.
Yes, yeah, yeah,
But
You had the cues, you had the
yeah.
yeah,
spiders.
yeah. But no, I was going to individual stocks,
Okay.
and I found that I'd get some quick gains, and then the things would fail within a week or two, and I'd be taking losses, and you could die with 1,000 paper cuts if
That's
you do it
true.
right.
Yep.
Absolutely. Yeah. So, and this is kind of a good starting point, because one of the things that we were asked a lot, and I've got a lot of data on markets and everything. Frequently asked question is, well, what percentage of these work? You've got this follow through day, and you say that, bull markets don't really start without one of these signals. And just so people remember, what we're talking about, a follow through day is after a downtrend. You have a rally day. That kind of is your first point. And then your second point is the confirmation of that rally. So you tend to be up with power. So we might use 1.25% or more sometimes in very volatile markets. And you want to see that volume being heavier than the day before. So that's your follow through day concept. So one of the things that people would ask a lot is, well, how many of them work? And the trick was, and I tried to nail Bill down on this, and he was a little squirrely on it. He bobbed and weaved whenever the question would come up. But the biggest question is, well, what does it mean to work? What is the definition of a successful follow through day? And you almost have to start with that before you do anything. So where did you come down on that to come up with your statistics?
Well, that question was exactly what vexed me too. When you start to have to define what is success, I started to try my own methods, and then I wrote an email to Chris Gessel when I came up with some numbers to see what do you think about how I'm defining this. And I was lucky to get a response back so quickly, and he kind of said, well, it sounds like what you're doing would work and would be consistent with what Bill thinks. So so I went ahead and I started looking at um, you need a certain amount of time for the rally to be successful, and you also need a certain amount of gain. I mean, it sounds pretty obvious, right?
Right.
But what numbers would you pick, right? So I looked at a scatter diagram of everything I had in terms of how long a follow through or how long a rally lasted and what percent gain you would get at the end. And when I looked at the scatter diagram, I started drawing lines in, and it came out with, I think you need a rally to be long enough to make some money or give you enough time to get out would be 15 trading days or 3 weeks. And you need to have an increase.
Watching the video, maybe we could show that slide to just kind of drum that point home.
And you can see there's that scatter diagram, and there's a lot of clustering right around the axis there. But the main thing was it came pretty clear to me you need to have some sort of gain. It looked like 3% was an index gain that qualified for a level where you could start to make money. On anything below 3% was a small losses or gain, and anything less than 15 days was just a whipsaw. And so that's kind of how I drew the lines.
And all of these individual dots were follow through days that you went back. And so I'm assuming you started out with kind of the paper on digital or maybe even daily graphs. And then you also went back and were looking at papers from the library, right?
You got it. Luckily, there was a group in Petaluma, Lee Tanner's group, and they had some people go to the library and go through all the newspapers back to 1994, and they shared that with me, and I thanked them for that. And I went from that further back by making a little program in TradeStation that would allow me to go back on the Dow back to 1949. So I was able to trace back to 1949. With TradeStation. And also I found some little hidden Easter eggs that to me, they were hidden Easter eggs. When I was looking at the 30th anniversary IBD charts of the America's Greatest Opportunity Stocks, I assume Justin annotated these. And there were on those charts, there were relative strength lines on some of them. And there were days with little lines that showed follow through days. I was like, wait a minute. And then it made me think, what if they did this in all the level 1 or 2 or 3 or 4 books? And sure enough, in the I think it was in the not the market school had, but also the Model Stock Summit.
Yeah, Model Stock Summit. Right.
And some of the chart schools, it's like, oh, I can find, if I look at these charts, follow through days that go prior to when the paper was made. And I started to double check things, and I started making my own criteria. And I was able to go back to 1949 and come up with follow through days.
And this was across different indexes, right? Because I mean, we certainly say that you only need one of the indexes to qualify as a follow through day in order to move things into a confirmed rally. So you were looking at all the indexes?
All the indices. And, at some point you had to use the Dow because there was no S&P 500. And I think
exactly
the same thing with the NASDAQ. So yeah,
the NASDAQ didn't come around until 73. So if you want 1949, you're not using the NASDAQ. So, right. So, and maybe go into a little bit more of, we'll get into it, but this whole idea of the slog. So what is the slog?
The slog is an acronym for small losses or gains. And a slog is one rally where it's you get less than a 3% gain, and it lasts, I'm trying to remember now, it goes between 15 days. It's longer than 15 days, but you get a gain of only 3% or less.
And you would end it when IBD would switch it back to a marketing correction?
Exactly.
Okay.
The day the market goes into a correction, is when you say that's the end of the rally, and then you measure how much it gained from the close of the follow-through day to that end date, and then that's how you find out what percent the index gained.
Okay.
Now, what about the peak? Because sometimes the market can come off its peak quite a bit. So did you have that factor in there as well?
I did measure what the peak gains were, but when it came to trying to categorize everything, I mean, it would be really complicated if you showed a lot of charts with two different numbers. But I decided to use the close on the rally end date, because the reality is most people don't know when the peak is occurring. You're not selling your stocks or your ETF.
I can tell you after the fact, Eric.
Yeah.
I can nail it every time.
And so I always felt like it was a little bit conservative to use the rally end date, but the truth is most people would probably sell some stocks as the market started to come down, and then hold on to others, because you always think you have like the next Cisco or some sort of long-term winner. And so people would probably sell some and hold on to others.
And were there some kind of common characteristics that were different in the life changer or moneymaker versus a slog kind of early on in that 15-day range after the fall through day?
There were, and to me, the most surprising thing was the things I expected to be factors that would make a difference ended up not being factors that meant anything at all. For example, when I first started the study, I thought, well, the follow-through days that work, they'll probably be the ones that have the biggest increase in volume from the prior day to the day of the follow-through day. And that was not the case. In fact, I also found, I thought, well, maybe the price increase. If the follow-through day has a really big price increase, that is going to say this is a rally that's going to work and be a long-term money maker or a life changer. And again, that was not the case. And I think it kind of goes in line with some of the biggest up days in market histories are during bear markets. And so it's not surprising that you could have a big gain on a follow-through day that ends up being a whipsaw or a slog or something, because many times it occurs follow through day after a big downtrend and a washout, and those end up being rallies that don't work.
Especially since when you started, you had just come after a big market correction where you had some of those biggest days in the NASDAQ, days that were over 10%, and then that once in a lifetime event, we had another one not too long after that in 2008. Yeah, exactly. I was told that was a once in a lifetime event, and I want my money back on that one. So in addition to the kind of that initial day, there's the follow through day and the size gain and the volume. So again, you didn't find much of a correlation there, but what about those first, I guess, week or two, or first month? Is there information that kind of tells you the action of the indexes that tells you, hey, this is something that's working? Or ideally, if you can find out quickly it's not working, you step aside before you get run over by that truck.
And let's talk about the ones that help you step aside first. I found two things that are really good indicators of whether the rally is going to fail or not. The first one is if you get professional distribution, or a day where the index drops more than 0.2% and heavier volume than the day before. If you get that on day one, right after the follow through day, or day two, or day three, there is an 80% chance that rally will end up being a whipsaw or a slog, something you really can't make money at. And in fact, if you get two of those 3 days, the odds go from like 80% to like 90 to 95% that will not be a rally you can make money. And so right after a follow through day, watch for professional distribution. If you get it, you should start thinking about backing off in any investing, or not investing money at all if you haven't started yet. The second thing is, if you get a close below the low of the follow through day, that is even a better indicator. Over 90% of the rallies fail or become whipsaws or slogs if you get a close below the low of the follow through day.
Was there a date range between that within the first? Was it within those first 15 days, or it just didn't matter at that point?
It really doesn't matter. I mean, like, I would say if you get within the first 15 days, but most of them occur sooner than that. But if you get a close below that within the first 15 days, watch out.
That makes a lot of sense.
And so people know, a lot of times we use as our line in the sand the low of the rally day, right? So that's when things officially fail.
Right.
But as you say, there's indicators a lot of times.
Mm-hmm.
Sometimes you'll see it in your individual stocks. Sometimes you'll see that weakness in the indexes ahead of time or the distribution. One thing I will say, because I know Chris, gosh, this was over a decade. Chris Gessel, our chief content officer, came to that conclusion of the distribution right after a follow through day.
Yes.
And as I was looking at his data, the one caveat, because I was showing it to Bill too, and the one caveat is that there were some very powerful rallies, some of those life changer rallies that ended up having distribution in that first 3-day window.
Right.
And so you have to be very careful sometimes,
Wow.
knowing, okay, here's how the statistics go, but you can have a life changer in having some of these factors, especially the distribution one.
And I found the same thing, and my data agrees. It's like 80% chance it's not a good rally, but there's 20% that would be. So.
Right,
Yeah,
right.
like if it can rally, now it's gonna be
Yeah.
it could be a life changer rally at that
Yeah.
point.
Yeah.
That's pretty incredible.
Okay, well, let's go ahead and take a break real quick, and when we come back, we're going to get into some more of the findings of the follow-through day and see how we can apply some of these to the current rally. Stay tuned. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
Welcome back to the Investing with IBD podcast, sponsored by North Coast. It's Justin Nielsen here, along with Arusha Pires and our special guest, Eric Krull, co-author of the Lifecycle Trade and manager and founder of Krull Asset Management. So, Eric, we were talking a little bit about how these different categories kind of pan out. So maybe we could show this chart for folks that are watching the video that kind of show the distribution of where the money-making opportunities are and where they're not. Could you talk about that a little bit?
Sure. What was really illustrative to me was that you end up with opportunities to make money only about 31% of the time. And that was a big surprise. You end up with about 69% of the time, they're not, follow-through days do not produce good money-making opportunities. But 43% of those 69 end up being ones where you get small losses or gains. So you get just enough time to find out that maybe it's working, and you can probably get out without too much problem. And so when you add up that 43% of the small losses or gains with that 31% of making money, you get the magic 75% that I was pursuing many years earlier from the book. It's like, how can you say 70-80% of them work? And you can do that by saying, if you count the ones where you can make money or get out with a small loss or gain, or have enough time to see it isn't working, that's where you can get the 70 to 75%.
Well, and also, I guess another point here is that this is what the indexes do, but sometimes you have those individual stocks that are even more powerful.
Exactly. When you look at like the percent gains that I show for, let's say, the life changers, which are more than 15% gains for the index, and money makers, which are between 3% and 15%, you have to remember that's the index. You've got stocks, that individual stocks that are going to gain much more than that.
And I was going to ask, I was going to kind of go off the same thing where obviously you were just focusing on follow-through days here, but a lot of times when we're looking to buy, as you mentioned earlier, we're going for those individual stocks. And so if you see one of those great growth stocks setting up, that's when you're really going for it. And you can almost tell at that point that maybe the odds are a little bit better because there are a number of great growth stocks setting up and they're all kind of breaking out one after the other.
Exactly. I mean, we're talking a lot about the indices here, but you also have to look at what are the leading industry groups, not just the index, and what are some of the leading stocks in the leading industries. So
let's talk about additional follow-through days, because that's something that definitely when I started learning about this 20 plus years ago, we weren't really talking about it, but I feel like we're talking about additional follow-through days and just kind of at least noting them, saying, hey, there's here's another day that would have qualified for a follow-through day if we didn't get the previous one. Did you look into any of those characteristics to see if it improved the odds for a rally or a moneymaker type of event?
Yes, I did. And what I found was this, and no surprise here, follow-through days produce rallies that work when you start to see that you get additional follow-through days or subsequent follow-through days, and the indices are starting to rise. No surprise, right?
Yeah.
That a rally that's could be one to make money is one that's working as you start going through it in the first 10 to 20 days. And I found that when you want to look at like the money makers and the life changers, you get additional follow through days, pretty quickly after that. And what I found was within the first 20 trading days post the follow through, you get on money makers and life changers about uh, 6 accumulation days where you get gains and heavier volume than the prior day, and 3 to 4 additional follow through days. And this current rally right now that we're in, it's looking like a slog and it feels like a slog. We haven't had any additional follow through days on the S&P since we are tracking this follow through day on the S&P index. I'm following the S&P, and there hasn't been any additional follow through days. The Nasdaq has had a couple, okay, but that's not the one that produced the follow through day this time. So you have to see additional follow through days, and you also want to see some pretty good gains. And what I mean by that is this: in the first 20 days, money makers gain about 5.5% on the index, and life changers gain almost 8%. And when I looked at today, mid intraday, the S&P was only up 2%, 2.2% from the follow through day, and we're on day 24. So this is an indication to me that this rally right now that we're in is a slog.
So you're talking about this kind of window of 20 to 25 days to kind of let you know, hey, is this one that's working? And it's certainly, we always find that the market does tend to act as this feedback mechanism, right? You start putting your money in, and okay, well, if it's working, you're going to get more kind of treats, like yeah, put more money in because it's working and everything. But is there anything to how long these last? So once you get that follow through day, how much time do you have in order to take advantage of the uptrend?
Less time than I thought before I did the study. What I found was approximately 80% of all rallies are finished within 50 trading days or less. And when I talk about days, I'm always talking trading days, not calendar days. So you're looking at 10 weeks of trading here. That was a really big surprise to me, where you end up with most rallies end up not going beyond 10 weeks. And how it changed my trading was that I started to realize that I shouldn't be hanging on to all my stocks as the rally gets longer like this, and start to sell laggards. When I say laggards, they may have gains, but they're not as good as maybe my leading stocks. And you start getting 8, 9, 10 weeks into the rally, start to, back off a little bit. It's not all or nothing decisions, when you do this. And maybe in some of the stocks, maybe they're up only 1, 2, 5%, something like that. Maybe sell the whole thing on that one. But then you have your bigger gains, you hold on to those. And as I started getting into 10 weeks, I start hedging. I start buying puts on those big positions because I know statistically, going back to 1949, the rallies don't last beyond 50 days very often.
That's really interesting. Yeah, I mean, that really does put in perspective, because it's a lot of times when these follow through days start working and you start making progress, and it's probably around 50 days into it, you're starting to think that, wow, you're pretty good at this. And you got it, and you have the best leaders, and they're never going to stop going up. So putting a little bit of a number to this really puts a little bit more perspective.
Yeah, and when you start to look for that vacation condo somewhere, that's about the time you need to start selling.
That's a market indicator right there.
Yeah.
Well, and also I think it also kind of speaks to that point where a lot of times people almost want too much evidence. It's like, I'm not going to start if they got out, they don't want to put their money back in until it's I really want to see all of these different signals. And if you're late, then gosh, you might not have much time if you get in too late.
Exactly. So, for example, right now, the current rally in the S&P, I think this is day 24. Based on that chart we just saw, we're about halfway done potentially with this rally. Now, it could keep going on longer. Maybe things improve with an earnings season here. We start to see more accumulation, and we see this market acting better, which are great signals. But if we're 20 days into it already and only have like a 2% gain in the index, and stocks don't look that well, it kind of tells you how you should be acting.
Yeah, and that almost goes right into your finishing right into the middle of May, and kind of lining up with the sell in May, go away type of truism that's out there.
Right. And then having done this follow-through day study, I found that truism doesn't work very well.
Fair enough.
Well, on IBD Live, we were talking about the era of commission versus the era of omission. And
Yeah.
the problem is if you get one of those powerful rallies that do end or do start between that May and October where you're supposed to, go away, well, shoot, you could be missing out on some great opportunities.
Exactly.
What about moving averages? Do you do any work on that and how that kind of correlates to a fall through day?
I did. I checked to see where the index closed on the follow-through day versus the 50-day moving average and the 200-day moving average. And what I found was the life changer rallies end up occurring most often if the index closes below both the 50 and the 200-day moving average.
Wow.
If you close above both of them, you can have a slog or moneymaker, but less likely a life changer. So it seems like the life changer rallies start after a really bad market when you have a follow through day and you're below both of those moving averages.
Yeah, I guess that kind of makes sense, right? You have the
Laws of
true
physics right there.
washout, right?
Yeah. You get a lot of instances where you get a follow through day when the index is above both of those after a minor correction. And then it goes on for a gain, but it's not a life changing gain. It's a little bit more of a money making opportunity where you can have subsequent money making, one after another, smaller gains, 2 or 3 of those in a row because the index is staying above those moving averages.
And I will just say one of the things that is a little bit tricky about these studies is, as you mentioned here, the positioning is very different. Have you come from a major correction where you are below both the 50 and the 200, or is this maybe an intermediate correction in an overall secular bull? And that's where it's going to be almost more of a pullback, not really a correction, but it'll be enough of a correction that it will have a follow-through day. And so again, those results may vary. Well, this has been great information on the follow-through day. So maybe we can turn our attention now to the current market so we can kind of talk a little bit about where we're at. You already alluded to this with the S&P 500 quite a bit. So maybe we start there and just remind folks that we did have that follow-through day on March 16th. And one of the things that was a little bit more powerful about the S&P 500 versus the NASDAQ is that it didn't undercut its February 24th low, and that's what allowed it to be in the position to have a follow-through day. So talk a little bit about where we're at right now and some of the things that you've seen that you like, some of the things that you've seen that you don't like.
All right. Well, the first thing about this follow-through day was it was on day 16, and most follow-through days occur much earlier than that. I think it was 80% of them occur on the 7th trading day after the first rally day or less. And so this was a day 16, a later one. And we've had some later ones that work. We've had some that occurred on day 21 and they turned out to be great rallies. So I was a little suspect on day 16, but not too much because I know it could be a good one. But what I noticed on the good news was there were no professional distribution days in the first 5 days of trading after the follow-through day. So that's good. We have not undercut the follow-through day low. That's another good sign. But we did not have any subsequent follow-through days that would have qualified as their own follow-through day since then. And also we're only up, like I said, I think it's maybe 2.2% since that follow-through day, and we're on day 24. So this has the characteristics of a slog or a small loss or gain scenario, where we end up with maybe a 3% gain in the index to 15% gain before we get our next correction. Now, of course, these are all just statistics and things can change. if Russia and Ukraine have some sort of peace agreement, and stocks that are reporting earnings in this quarter start having better than expected, and they start projecting better growth, well, that can change everything, and maybe the market takes off. But at least from a statistical viewpoint, right now, this is looking like a small loss or gain type of rally.
Yeah, this is kind of just like it's not our typical kind of rally, right? Where the growth stocks aren't the ones leading this time around. It's
Right.
all a lot of commodity stocks, and so the way I look at this, it's not kind of the O'Neill rally. But that being said, even though it is a slog right now, there have been a number of energy or commodity stocks that they're acting like they're in 2020. Right, they're just going through the roof right now. So it is
Metal,
really
fertilizers, the kind of things that
Yes.
normally we don't watch, right?
Exactly. Yeah. So it
Yeah.
is really interesting that we're seeing this environment that's not kind of our classic environment, and it's very easy to be thrown off if you're so used to using follow through days, looking for stocks in strong industry groups that are growth related. But meanwhile, all the top industry groups are more commodity related.
Exactly.
So maybe we can just take a look at the NASDAQ to kind of round out our market discussion, current market discussion. And as you mentioned, the follow-through day was a little bit later on the NASDAQ. One of the reasons, of course, was it did undercut its February 24th low, and so that kind of meant that you had to reset your count. You had to start counting again, and remember, we're typically looking at least day 4 or later before we count a follow-through day, and so that didn't happen on the NASDAQ until March 18th. But if you were using the NASDAQ, you have had some subsequent follow-through days. Is the position of those subsequent follow-through days an issue, though?
Not so much the position of them. I'm more concerned about the fact that we've given up a lot of those gains, and we really bumped up against that 200-day moving average, and that acted like resistance, and that made it look like it's not very good. And we've now had professional distribution on the NASDAQ. I forgot the count. Maybe you know that better than I do, Justin.
4?
But I think it's yeah, and that hasn't really happened so much on the S&P. So if we didn't have any professional distribution right away after that follow-through day for the NASDAQ, but we just recently have not been acting well at all.
Right. And it was pretty powerful. I mean, you had the follow-through on March 18th, and you had a subsequent follow-through day on March 24th, a subsequent follow-through day on March 29th, and that's when things kind of rolled over.
Exactly.
We actually got, technically yesterday was a subsequent follow-through day.
another
You were
one,
still
yes.
in the 25-day window. So yesterday was technically a subsequent follow-through day.
Exactly.
But I guess what I was alluding to is I've found that when you get your subsequent follow-through days, this was, the third subsequent follow-through day, but it was below the March 18th follow-through day and the other subsequent follow-through days. That doesn't speak highly.
I agree with you. And even if you're below the 21 exponential moving average, that's also not a good thing. You want to make some room above that, and so the positioning of that is right. I agree with you on that.
Well, this almost looks like it's a classic bear market rally, like we were talking about earlier. You're getting some really powerful days, and getting people excited. But when it gets to those critical resistance areas, now it's selling off, and then it's just kind of trapping everybody.
It sure does look like that, doesn't it?
But to Arusha's earlier point, of course, you have some of these other stocks that are doing something completely different from the indexes, and even the indexes themselves. It was kind of weird that at least this rally at the start, some of the most powerful days seemed like it was the bottom fishing that was really powering the indexes higher. Yesterday, I was looking at the NASDAQ 100 and the S&P 500, and the biggest gainers for that day, which it was a strong day, but the biggest gainers were all still below their 200-day moving average line. So,
right.
It kind of goes to your point about the setups. What kind of setups do you have in your individual stocks? And that's where this has been very different in terms of what's been setting up.
Exactly.
Well, let's go ahead and move on. In our next segment, what we're going to do is we're going to talk a little bit about some of the stocks that may be on your radar, and maybe some of the statistics that you used from your Lifecycle Trade book that you did with your co-authors might come into play there. So stay tuned. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
Welcome back to the Investing with IBD podcast, sponsored by North Coast. It's Justin Nielsen here, along with Arusha Pires from O'Neill Global Advisors and our special guest, Eric Krull, co-author of the Lifecycle Trade and manager and founder of Krull Asset Management. So, Eric, before we move on into some stocks, certainly because there's still slim pickings out there, let's go ahead and let you get a chance to do a kind of final thoughts on everything that you've kind of learned through all your studies. Boil it down into kind of a few bullet points for folks.
The main thing is this: when there's a follow through day, don't repeat the mistake I did way back in the early 2000s, where I was rushing in and plunging in with a lot of capital. So don't rush in with a lot of capital. Much of your gains are going to be made after the first week or two after a follow through day. Leading stocks and how they act are a key determinant of how and whether the rally will succeed. But it's also really hard to know whether in advance, you can't tell in advance whether the follow through day will produce a successful money making or life changing rally, and how it starts to act soon after the follow through day is key. So you buy a stock or two right after on a follow through day or soon after, and then if it starts to work and your stocks are rewarding you with gains, then you add to it. And then as a little bit later, if you get subsequent follow through days, then you add some more stocks or add more to the stocks you have. But just there's no reason to plunge in.
Well said, well said. So let's go ahead and turn our attention to some individual stocks. And one of the things that certainly seemed to come back on our radar this week was the reopening plays. Some of the travel, and I mean, certainly after the Delta Airlines earnings, we've also had the hotels. So maybe talk a little bit about Airbnb, and we should also mention here again the book. We've had Kathy Donnelly on, we've had E. Bobach on. Kurt Dale was also involved in that book, as well as yourself. So a lot of statistics on IPOs and how to handle those. So where does Airbnb fall with everything that you've learned from that Lifecycle Trade book that you did?
Well, if you can put it on a weekly chart, it's a little bit easier to see. You can see that there was an initial IPO advance phase right after the IPO, and then it peaked, and then it started to come on down. It didn't quite undercut the IPO day one low like most IPOs do, but it's in what we call now the institutional due diligence phase, where it's going sideways and it's going a long time, which is great. We like to see institutional due diligence phases of 6 months to a year to 2 years. And when it goes sideways like this, that's a sign that even in a bad market, they're not really selling this one off too much. Because if we could pull up a lot of IPOs and you can see they plunged way below their day one low and they're just looking terrible. But this one looks pretty good. It looks like it's setting up. It's got a nice flat relative strength line. And I'd be looking for this stock to go more than 30% off its low and form some sort of base like it looks like it might be doing now. And I'd like to see it break out in heavy volume and go from there. I expect it to run into some turbulence right around the old high. And if it can burst through that in heavy volume, that to me, that starts the institutional advance phase. And that's where I get really excited.
Yeah, it's really interesting because they're going to report earnings in a couple of weeks. And so maybe that's the catalyst to now explode through, test the resistance, maybe go into new highs and start that accumulation phase if they guide higher or really kind of
that's a
beat
great point. Yeah, that's a really good point. And I'd be right now not buying it in anticipation.
Right.
There's no reason to anticipate. You just wait and see.
Mm-hmm. Now, with some of these IPOs, how much is the fundamentals in terms of the revenue growth, the earnings growth, all of those things? Because it's had a little bit of spottiness there. Is that something that bothers you, or is that just part of that due diligence phase as it's kind of getting its ground, getting the ground underneath it?
I think you've nailed it. That is part of the due diligence phase. Institutional investors need to see how are the earnings growing, how are the sales growing before they really start to buy and accumulate the shares. What I see is, maybe 6 quarters ago and 7 quarters ago, they were red and not looking good. But if you start to show the positive growth, both in sales and earnings, that's what you need to see. And the other thing is the volume. Surprisingly, we found that if the stock trades less than $20 million of volume per day, that's also a bad indication. You want to see it trading more than that, so institutions can get in and get out without changing the price too much. And many IPOs do not trade that. In fact, we found like 78% of them are not liquid enough to trade, whereas Airbnb is one of those.
Well, we already have 4 funds from the IBD mutual fund index in the stock. Doesn't look
That's
like they're
also a good sign.
necessarily, yes, that's a good sign, and doesn't necessarily look like they're increasing just yet, but they're not necessarily selling too. So they're kind of just hanging in there and doing their due diligence and waiting probably for that earnings.
Exactly. Yeah.
Now, you mentioned while we were off air a stock that I had never heard of, LWLG. This is not one that's been on my radar. Another recent IPO. What is it that attracted you to this one, and what are some of the characteristics that are a little bit different from Airbnb, but are still within those statistics that you were finding out in your studies?
Well, Lightwave Technologies, they're an interesting company in that they're a chip making company that uses, instead of like the traditional small little, infinitesimally small wires, they use like light technology. So they have faster transmission of signals on the chip and also lower power. That's the big deal. If you can use a lot less power and you put up these server farms and you can cut your power cost by 20, 30, 40%, that also means you're also putting out a lot less heat and you can spend a lot less money on air conditioning for those server farms. So that's what attracted me from a fundamental viewpoint and story. But this one had a little bit of an IPO advance, short term in the weekly, came down, undercut its day one low, and then took off and it had a nice IPO advance, and it was a pretty powerful one in terms of percentage. And then with the bad market, it got really hit hard, and it undercut its first low there, and now starting to come back. And so I'm looking for this stock to go sideways a little bit longer. It's more than 30% off its low. I'd like to see it form its first base more than 30% off its low and then break out from there. And it looks like it's not obeying and it's trying to break out early. But I am watching it, and it's a stock that doesn't have as much volume as I'd like. It is below that $20 million per day of trading volume. So it's a little bit more risky, but it is something I'm watching.
Do you see when a stock is acting like a Lightwave and it's now starting to come back 30% off its lows, that when it's going through the potential due diligence phase, does it need more time than right now? Or have you seen some that they just take off, or does it really just kind of depend on the market?
Most take more time than that.
Yeah.
And it is a little bit market dependent. If you go back a year ago when it seemed like there were a lot of IPOs just taking off and running, it was a different story. But what's working against it here is it's a little bit of a weak market, which really pushed it down hard and fast. But I'm surprised it's coming back as quickly as it is. So we'll see. It's choppy, a little volatile, and it's acting a little bit unusual compared to what we've seen for big winners.
So one of the things, and I'm not sure if you've looked into this, but I noticed that the revenue is, it doesn't have it yet. Do you know what's going on there? Are those just numbers that haven't been filled in, or?
That I don't know. I have to be honest with you. So I haven't done my due diligence yet. But
okay, hey, that's what the due diligence is for, right? Allows you to kick the tires. A lot of times we find these because of the technical action that's going on, and it's as you kick the tires and start figuring out what's going on there, that's where you learn more about it to see if it's something that you end up buying.
Right. Yeah, and there aren't too many funds in it. Well, there's 0 IBD mutual funds in it, and even just a number of funds. So people just starting to take a look into it. Yeah, it's pretty interesting.
Yeah, this is what I'm watching. I'm not in it yet, but it's something that I'm just keeping an eye on.
Yeah. Well, and you kind of almost alluded to that you have this kind of categorized differently. This is maybe, because of it not having the ownership yet, because it's a little bit lower liquidity. Is there a time factor that you have an expectation where in that first year or two of the IPO where, hey, maybe it's going to be doing a lot of this dilly-dallying around before it really shows its stripes of what its potential is? Or that this is just not something that's going to work, which again, people have to remember. You get, you have all these people that get excited about, oh, well, I want to get the IPO, and they remember all the winners, but they don't remember how many, because you never think of the ones that, don't work. No one thinks about those. So what I think you've already alluded to the category here.
Yeah, my time frame would be, a year to 2 years after its IPO, initial public offering. That's when I start to really get a little bit more interested in it, because by then, if it's 1 to 2 years, you're looking at they've already had 4 to 8 earnings cycles that they've reported, and that's when institutions can decide whether or not they're investing in it, and it should show up by then.
Mm-hmm. And certainly with the IPO craze that we had last year, I mean, it was, breaking records. Now, SPACs, the special purpose acquisition companies, were a big part of that kind of IPO craze. Do you feel like things might need a little bit more time here because things got so crazy in 2021?
I think so. I think there were 844 IPOs last year, and about half of those were SPACs.
Wow.
And those turn out to be, in general, a terrible investment for most people. If you bought, like from when the day they announced their acquisition candidate or something like that, those ended up, most of them being just money losers. And I think a lot of that excess has to be worked out of the pipeline, the system. I think a lot of people have been burnt. Institutional investors, I think, are going to be more shy, and I think it's going to take a long time before the SPAC route is something people will be interested in. And with this market the way it is right now, this is not a good market from January till now. The IPO pipeline is pretty much dried up. So I expect as the market gets better, you'll start to see the best IPOs coming on, in line again to go public. But I don't think you'll see too many SPACs. We'll see.
Mm-hmm. And you mentioned how the January, it's been a little bit tough since January, but for a lot of these growth stocks and some of these IPOs and SPACs, it really seemed like a lot of their tops were actually in February of last year. So you still had that craze going on that you were mentioning, again, over 800. You still had that craze going on, even though a lot of these were running into trouble much earlier.
Yeah, and if you pulled up any charts from SPACs or IPOs after August, the vast majority didn't have any gains, and they went just decayed down.
Okay, let's go ahead and round out the discussion with Dutch Bros, which this is one that's been just seeming to be on the lips of everyone, especially growth investors. It's really kind of captured, I guess, the imagination of what could be possible. Why do you think that is on Dutch Bros?
I just remember Bill O'Neill saying that in all, of his investing career, there were some industry groups that he made a lot of money in, and retail was one of them. This is a retail establishment. If you come up with a good concept and it's good in its one area, then you can expand nationwide and just keep growing. And maybe that's what people see with this one. I don't know. There's not any of these Dutch brothers near me, but it looks like in terms of the way the stock's performance is looking, it had a quick IPO advance, came down in a bad market, and now it's going sideways in this due diligence phase, chopping up and down. And again, it looks like it's more than 30% off the low already, but I'd be looking for a good base formation and then a breakout in heavy volume from a proper base. Not sure what they do that's different than other places like Starbucks, but it seems to have caught the attention of a lot of people, and we'll see how it acts.
Yeah, I actually looked into this. It's a pretty interesting story, but they have it's hot or cold espresso drinks, energy drinks, and they really encourage customization. And the way I looked at it is, it was a lot of sugary drinks. So you're getting all these customers addicted to their drinks, and it was a really interesting kind of environment there with the workers there. It looked like a really fun environment. Very small stores, drive-throughs, and the lines apparently are just huge for this. And a lot of people they're younger, female, and they're going to these stores after 12, a lot of them, which I thought was really interesting. So while it is
midnight?
No, after 12 noon.
Okay.
So they're competing with Starbucks, but not necessarily. So they have they've been around since 1992, and just been slowly growing and growing, and they're nowhere on the east just yet, and so it's all kind of West Coast right now, which is one of those kind of there is a market to grow into. So it is kind of interesting, and it doesn't surprise me that people are keeping an eye on it.
Mm-hmm. Yeah, and just as you said, Eric, I mean, it's with these retail establishment, it's that expansion that really can power stocks. I mean, you see that over and over, especially in the restaurants related, whether it's Chipotle, McDonald's, what have you. There's just so many examples in our model book stocks of these retail places that expand, and that's where the big gains come from in the stock. So
look at that relative strength line, how flat that is.
Yeah.
If we can get a breakout in heavy volume, maybe after a good earnings report, that would really be a good sign. And then again, expect some turbulence near the old high, and then if you can power through that, then you're looking at a nice institutional advance phase.
Wonderful. Well, Eric, it was great having you on the show. Great to see you. Again, you have a soft spot in my heart. One of the first times I went to a big speaking event was at your meetup group, and it was like last minute. They threw me on a plane, and yeah, you were just so kind and helpful to me on one of my first ones. So great having you on the show, and thank you so much for doing that digging into the statistics and everything like that, and sharing your data with us, because it certainly helps, I think, for our subscribers to know those statistics when they're doing their own investing to get that success rate higher for them.
Thank you very much, and thanks for the kind words. And I'll just echo, it was really great when you came out to Naperville many years ago. We had a good time. I thought you were very generous with your time and with your knowledge, and we really appreciated it back then. And I know you're a data guy, so one of these days I'm going to update this study, and we'll because you always keep updating, right? Because we get more follow-through days.
Yep.
And
I update every night for market school, and I should also mention that was another funny thing. You were in that first market school that we did, right?
yes,
Yeah.
yes.
So you were among the guinea pigs. We're like, hey, we've got this concept. We're going to throw it out there, and man, we were like, oh, we really tried to simplify it as much as possible, and you had.
Yeah.
You had a number of, we tested it out in Chicago specifically because we had some of our most sophisticated investors out there, and Eric was like, "Okay, guys, here's my feedback."
I think your chart books were still warm when you guys delivered them that morning.
Exactly. Yeah, it was a fun time, and wasn't that where we had an Indian wedding going on?
Yeah,
right outside the hotel,
right
and
outside.
some
Yep.
elephants were going down the street,
Yeah.
and it was very
Yep.
interesting. So,
Yeah.
again, great seeing you, Eric. Always a pleasure.
Thank you. It was great to be with you guys.
Okay. Well, that's it for this week's Investing with IBD podcast. Next week, Arusha, you're ditching me. Is that right?
I am happily.
Yes. Happily ditching me. So we will have to go without Arusha, but that's okay, because David Saito Chung, the deputy markets editor at Investors Business Daily, will be with me, and we'll be getting his thoughts on the market as it stands. So stay tuned for that. Thanks for watching this show. We'll see you next week. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.